The U.S. and Israeli strikes on Iran didn't just kill Supreme Leader Khamenei on February 28th. They triggered something the global economy hasn't faced in decades. Iran's retaliation, shutting the Strait of Hormuz, choked off 20 million barrels of oil a day and a fifth of the world's natural gas. What happens next determines whether you're paying $4 a gallon or heading into a global recession. At 2 a.m. on February 28, 2026, a wave of American and Israeli warplanes crossed into Iranian airspace. Their targets were not limited to missile silos or air defense batteries. This was a coordinated strike against the backbone of Iran's military and nuclear infrastructure. Precision-guided bombs hit launch sites in Abadan and Kerman, the Natanz enrichment facility, and the Imam Khomeini Air Base. But the real shock came in Tehran's Darban district, where 3 missiles struck the Supreme Leader's private compound. By 4:10 a.m., Iran's official news agency confirmed what intelligence analysts had only speculated. Ayatollah Ali Khamenei, the country's highest authority for nearly 4 decades, was dead. Within hours, the Iranian Revolutionary Guard declared the Strait of Hormuz closed. Naval mines were laid, coastal missile batteries activated, and a sweeping electronic blackout jammed the navigation systems of more than 1,000 ships in the Gulf. Commercial insurers immediately pulled war risk coverage, making it impossible for any oil tanker or liquefied natural gas carrier to legally transit the strait. The world's most important energy corridor, responsible for nearly a third of global seaborne crude, was sealed off by a single order. Retaliation was not limited to words. Iranian-backed militias launched rockets into Saudi Arabia and the UAE. Major Gulf ports went on lockdown. By sunrise, ship tracking data showed a 70% collapse in tanker traffic through Hormuz. Only a handful of Iranian and Chinese flagged vessels, granted special passage, continued to move. For everyone else, the route was simply gone. In less than 12 hours, the global energy map was redrawn, and the consequences began rippling through every corner of the world economy. The Strait of Hormuz is not just a line on the map. It is the narrow throat through which about 20 million barrels of oil flow every single day. That is nearly 1 out of every 5 barrels the world uses, and more than a third of global seaborne crude. It is also the main route for 20% of all liquefied natural gas, most of it coming from Qatar. When the strait closes, there is no easy backup. Pipelines cannot make up the difference, and alternative shipping routes add weeks to delivery times and millions in extra costs. 5 countries are especially exposed: China, Japan, India, South Korea, and the European Union. China alone imports roughly 70% of its crude, much of it through Hormuz. Japan and South Korea rely on Middle East oil and gas for 80 to 90% of their needs. Europe gets around half its imported oil and a growing share of its LNG from this corridor. Even the United States, with its shale boom, is not insulated. Global prices set the baseline for everything from gasoline to jet fuel. This is why the world's biggest energy companies and trading houses track every tanker that enters Hormuz. A single disruption, even for a few days, can wipe out 2 million barrels a day from the market, about 5% of global demand. That is a gap no one can fill overnight. The International Energy Agency's flow maps show the physical constraint. When the strait is blocked, the supply chain seizes up. Oil tankers cannot move, LNG carriers are stranded, and refineries from Rotterdam to Shanghai are suddenly short of feedstock. The vulnerability is not theoretical. It is measured in barrels, ships, and hours, And it is the reason a crisis in this 21-mile-wide waterway can send shockwaves through every corner of the global economy. Oil traders didn't wait for the dust to settle. Within hours of the Strait of Hormuz closing, global benchmarks exploded. Brent crude shot past $112 a barrel, up nearly a third from the day before. West Texas Intermediate, the main U.S. benchmark, hit $110. The path to $100 oil wasn't a forecast anymore. It was a reality, visible in real time on Bloomberg's tickers. This wasn't just a headline for the business pages. It was a direct hit to every corner of the economy. The shock wasn't limited to raw oil. Insurance markets went into panic mode. War risk premiums for tankers, what ship owners pay to cover the threat of missile strikes or mines, jumped from $12,000 to over $30,000 per voyage through the Gulf. For shipping companies, that is a cost spike nobody can ignore. The world's biggest container lines, still haunted by the supply chain chaos of recent years, slapped emergency surcharges on everything from electronics to grain. Spot freight rates on Asia to Europe routes surged as much as 60% in a matter of days. For drivers, the pain arrived at the pump almost instantly. U.S. gasoline prices, which had hovered near $3 a gallon, began climbing toward $3.50 a gallon. In some states, stations posted daily increases of 10 to 15 cents. The math is simple. Every $10 jump in crude adds roughly a quarter to a gallon of gas. For a family filling up twice a week, that is an extra $40 to $50 a month, money that does not go to groceries, rent, or savings. The price spike moved fast because the supply loss was real and immediate. With nearly 1/5 of the world's oil and 1/5 of its liquefied natural gas suddenly off the market, traders scrambled to secure cargoes. The world's energy bill ballooned overnight, and with insurers pricing in the worst, no one could say how high costs might go if the strait stayed closed. The first wave of the crisis wasn't abstract. It was measured in dollars at the pump, surcharges on shipping invoices, and a new sense of fragility in the global economy. Energy sits at the heart of every household budget, and when prices jump, the impact is immediate and relentless. In the days after the Strait of Hormuz closed, the world's main liquefied natural gas price, JKM, the benchmark used in Asia, leapt from $12 to as high as $19 per million British thermal units. That is not just a chart moving on a screen. It means higher utility bills, more expensive groceries, and rising costs for everything that relies on shipping or refrigeration. In the United States, energy makes up about 8% of the Consumer Price Index, the government's main measure of inflation. Gasoline alone accounts for 3.5%, with electricity and home heating adding another 2.5%. When fuel and power costs surge, they ripple through every other category, from airline tickets to food and rent. Economists are already running the numbers. A sustained jump in oil and gas prices of this magnitude adds between 0.4 and 0.7 percentage points to headline inflation. For a country that had finally seen price growth cool to around 2.4%, that is a hard reversal. If the crisis drags on, headline inflation could push well above 4% within months. The Federal Reserve, which had been preparing to cut interest rates, now faces a stark choice. It can keep borrowing costs high to contain inflation, or it can risk letting price pressures spin out of control. In early March, traders slashed the odds of a rate cut below 20% and began betting on a possible rate hike instead. This is the feedback loop that central bankers fear most. Higher energy costs squeeze household budgets, but they also force up the price of moving goods, running factories, and keeping the lights on. Each step in that chain feeds back into the official inflation numbers, making it harder for policymakers to bring relief. The longer the strait stays closed, the more this pressure builds, not just in the United States, but across every economy that relies on imported energy. The question is no longer whether inflation will rise, but how much pain households and businesses can absorb before the shock forces a broader slowdown. The fallout from the Strait of Hormuz closure is not distributed evenly. Some regions are absorbing the shock, while others are quietly cashing in. On the trade front, the cost of shipping a standard container from Asia to Europe has surged by 40 to 60%, according to Drury. That is an extra $1,200 to $1,500 for every box of electronics, clothing, or machinery. For European importers and Asian exporters, these numbers mean thinner profit margins and higher prices on store shelves. Retailers in Germany, France, and the UK are already warning of delayed shipments and new rounds of price hikes. Meanwhile, Russia is seeing an unexpected windfall. With Western sanctions still in place, Moscow's oil was already trading at a discount. But now, as global prices jump, Russian barrels are fetching more revenue even at lower volumes. The longer the disruption lasts, the more this gap widens. Across the map, the pain and gain are anything but equal. Some economies are scrambling to contain the fallout, while a few outliers stand to benefit from the chaos. Everything now hinges on how long the Strait of Hormuz stays closed. If the crisis resolves quickly, within 2 to 4 weeks, markets will breathe a sigh of relief. Oil prices could settle back below $100 a barrel, and U.S. gasoline might retreat to $3.35 or $3.50 per gallon. Inflation would tick up, but likely stay under 4%. The IMF's stress tests put the chance of a global recession below 15% in this short war scenario. But if the standoff drags on for months, the pain compounds. Crude could hold above $120 a barrel, pushing gas well past $4 per gallon, and headline inflation in advanced economies could breach 4%. The odds of a recession jump to as high as 45%. For President Trump, every extra week of disruption brings tighter polling margins, sharper questions in Congress, and a shrinking window before midterm elections. Households, too, will be watching. Each week means more at the pump, on utility bills, and at the checkout line. Policymakers are out of easy options. The world is now on a clock, and everyone's next move matters. Right now, every household feels the shock. Oil at $110 a barrel, gas up 50 cents overnight, and inflation climbing past 4%. The strait's closure isn't just a headline, it's your grocery bill, your job security, your economy. In a world this connected, no wallet stays untouched.